Let's hit record. Did it give you a message that it's recording?
Yes.
Okay, perfect. Thank you for that. So I'm going to share a tool that I use. It's called Tweak Now. It's a registry cleaner that I've used for probably 2 decades. And it is simply uh, the ability to do some um, disk cleaning. So I always go to the Windows cleaner. You can do troubleshooting and quick optimizing as well. But if you use a disk cleaner, I start at the left and go to the right, and it'll just scan. So it'll start scanning all these files, blah, blah, blah. And then it'll give you an update, and it'll allow you to clean the files, delete some of the bad files, but it's a very safe tool. There's a registry cleaner. You can scan now, it'll do the same thing. It'll check for if there's problems like in your file folders and organization and stuff like that. And then I use a track cleaner to get rid of any tracking items or cookies or something like that. It's very simple, clean now, and it tells you that. And then the last thing that I do is I use the disk defragmenter, the registry defragmenter. It kind of puts everything in order so your computer can find things along the way, and it's super quick and super easy. So on mine, it will take about 60 seconds, and then it'll ask you to reboot and wipe out your memory. So that's a little tool that I use to keep my system at home. A lot of people are working remotely, and so that makes it very nice to do that system cleaning. So it looks like, do we have the message that the system that is still being recorded?
Yes.
Okay, perfect. Thank you for that. Okay, so I'm going to have everybody go on mute for a little bit, and then at the end, we'll have question and answer. So if you have a question, please put it in the chat. That way we can get through a lot of the presentation, and most likely your questions will be answered. But feel free to drop it in the chat so we can make sure and get those questions answered. And Shinoa had asked me to go ahead and do these trainings. This is going to be on commercial real estate, commercial multifamily due diligence. And then the next in the series is going to be how to invest in your first commercial deal. That'll be coming out at the first of the year. So my name is DL Campbell. I have 19 years of commercial real estate experience. I have development and construction in my background. I can do accounting at a CPA level. And I came out of the corporate world as an engineer. So that was, a few decades ago. And it was about 3% women in my field in engineering. I have 23 years of SAP experience in all of the modules in finance, sales and distribution, manufacturing, production, and treasury reporting, audit. So my background is very siloed in its approach, but it has a number of disciplines to it. And your profession, your experience probably has the same. You probably have very deep experience into certain things that you can leverage in your commercial real estate career, and you can bring those over. Like engineers make great investors because we like to set up systems. So if you have that logic driven capacity, and the Lord has wired you as a logic driven person, then commercial real estate is a great option, commercial multifamily. Now, if you are thinking with the other side of your brain and you're more creative, you're more people oriented over task oriented, then you probably have some very siloed, deep experience working with people, connecting, and the Lord has wired you that way. And you're just going to be happier if you are working the way that you are wired. So in commercial multifamily, there's the leasing part, there's the capital raising part, working with people. There's the property management piece as well. And then if you're somewhere in between and you have balanced out your personality, then you can flip back and forth between those sides of your brain and be comfortable. But you're really going to be happiest if you're working just the way that you're wired. So that was a freebie, no extra charge. Okay. So active versus passive investing. So how many people understand what an active investor is? Okay. Everybody understand? Just raise your hand on the little computer guy and uh, give us a thumbs up if you understand what active investing is. Hi, Terry. Hi, Lisa. Hi, Young. Hi, Tally. Okay, a lot of people are understanding this. So active investing is where, great, thank you, Christy. We're going to be doing all the work as an active investor. That means you're going to be checking out the markets, choosing what asset class you want to invest in. And if you have any questions at all, pop it in the chat so you don't lose that idea. You're going to be driving the miles and researching the internet and finding those deals. Now, this is a very common market. It feels strange for people who have been in the market for a couple years because the syndicators have kind of messed up that market. The interest rates were way too low for way too long. It was a very weird market for me. They were buying anything and everything and not really paying attention to the numbers. And Shinoe has the same mindset. She wants to hear the numbers, right? So she wants to see how that analysis is gonna play out. So that's one of the reasons that we're doing this in-depth training on commercial, so that we're doing the analyses. So this is the kind of market where even though the interest rates are a little bit high, they are a little high. We need to wait a couple quarters before they start coming down. That you may need to analyze 50 deals to find one smoking deal. You may need to analyze 100 deals to find one smoking deal. And that's okay because you're not losing money. You're not losing time. It's much cheaper to fail on paper than it is to go out and just buy something to buy something. So if we're acting as an active investor, we're doing all that legwork. We're talking to people, getting the investments. We're driving the miles and researching the internet. And we're going into a contract with the seller with a letter of intent, an LOI. It's not binding, so you might as well put an LOI in, but we want to be careful and not tie up somebody's property for 10 days if we really don't mean it. And then if we do our due diligence and want to go forward with something like a phase 1 environmental report where they're testing for brownfield dumping, has somebody dumped oil on the property and that has to be cleaned up environmentally? Is there an underground tank that we have to be aware of? So if we are sure that we want to take that next step and do the phase 1, then we would go into contract and we would put our stipulations in. Well, we have on a normal market, you would have 30 days to do your physical due diligence on the property and 30 days to do financial due diligence. So the syndicators have kind of messed up the market. A lot of sellers are requiring a non-refundable down payment, earnest money down payment. That's just crazy. I mean, who's going to put in $25,000 or $50,000 of earnest money that's non-refundable. But the bad thing about that is that buyers have done it. So we have to be careful how we're training our sellers as well. Um, we're doing all the work, we're active. We are, if we're going into contract, we're negotiating all of the um, due diligence points that we want to do. We're gathering all of the financial statements from this owner. If they don't have audited financial statements, we want 12 months of bank statements. So it's a lot of work. We work in teams, right? Because Phil says commercial real estate is a team sport. It's also from the honors way perspective and from 20 years of experience, it's also safer because you're diversified. So with multifamily, you have multiple units and multiple tenants paying down that mortgage, and the bank knows that I can't pay that mortgage, the tenants have to. So the property has to qualify. And that's a good thing because we want to make sure that our numbers are conservative in our analysis and that the property is going to qualify and pay their bills. So what if it's 50% vacant? What does that scenario look like? Probably the worst case scenario. If it's 80% vacant, maybe a medium case scenario. What does that scenario look like? And best case scenario, about 93% because the bank requires to have a 7% vacancy rate in your numbers. So we want to be running all of those numbers. And if a deal gets that far in your analysis program, then you probably would want to take it to the next step. And it's only if the numbers work, 3% vacancy in Dallas is not what we put into our stabilized year one budget. We have to put 7% vacancy. We have to put 45% gross operating expenses if it's in the south, or if it's in the north on an as-built or an existing property. Probably 55% expense ratio off of the gross operating income. So we want to put those kind of big buffers in there. Somebody might say, hey, I can make this property perform better than anybody else. Well, what makes us so sure that we can? So we have to be the active investor, and we have to be thinking through all of those things for our partners. So some of the things that people can bring to a deal, if you're going to split a deal, is you can bring, as part of the piece of the pie, you can bring credit, you can bring cash, you can bring the deal, you can bring contacts, you can bring time. So Robert Kiyosaki talks about that. Everybody know Robert Kiyosaki? Rich Dad, Poor Dad, the cash flow quadrant. Thank you for that. Yeah. Rich Dad, Poor Dad. And he also built those games, Cash Flow One-on-One, to practice the monopoly type mindset. So we can break up a deal based on qualities and things that we have in our tool belt to analyze that partnership and say, okay, I'm doing 3/5 and you're doing 2/5. Now we know how the split is going to work. So the other thing you're going to do as an active investor or as a sponsor or owner, like we are, we're the owners of the Prestige at Mayhill, and you can you will do a cost analysis of all the repairs that need to be done, get your general contractor out there, get 5 or 6 bids. If it's over $600, you want to get about 6 bids and learn from your bidders. And get that CapEx, that capital expenditure number, so that you know how much capital that you need to raise on top of the capital raise for taking down the property. And you need to put your property management team in place. We like to let the current property manager stay on for 3 months and then replace them so that we can learn all their systems, but they're going to be loyal to the former seller. So we always replace them. We do the knowledge sharing. Of course, we're going to give them notice and take care of them, but you're just never going to be able to train them to do the things that you want in the way that you want it to be done. Make sense? Okay, so now we're into run and maintain. We're going to fix all the things that need fixing. We're going to force some vacancy, do some repairs. And here's an example, because my first property, I've never done single family. I mean, I have never done single family investment. I started with commercial. It made sense that it was safer, and I started with a 16 plex. So that's 16 doors on one property, and it was the right size for me. I know that the recommendation is to start with 20 units or more so that you have enough uh, income on the property to put a property manager there. So what I did was I started with a 16 plex in East Dallas. Later found out there was an F crime rate. Of course, that's where these C class are. Um, and I forced 80% vacancy. I was still working as an engineer. So if you're working, keep your job and transition out. You've put a lot of effort into that career. And I used my discretionary income to pay for the property, and then the property paid me back. So 16 doors, 16 faucets that are the same. That's that gives you leverage. 16 refrigerators that should be the same, and the showers that should be the same. And this one needed to have paint, etc. So we painted everything the same color. It was all different colors on inside and out. So that was my first deal. I picked it up on a lease with an option to purchase, and actually lived on site, forced all of the drug dealers off and the prostitutes, and I did the rehab, and I re-tenanted with small working families. So we forced all the drugs off the property, no more needles on the property, no more beer cans around on the property, but it ended up changing over to toys. And the children were able to come home and do their homework and focus on their lives instead of the other stuff that they were focusing on. And so for us, for me, I did it myself. It was kind of a circle effect. You know, we put the pebble into the pond, and um, you know, the ripple effect, the whole neighborhood settled down. So in the first year, I implemented these strategies, and I doubled the property value. 435,000 made it worth about $1 million in the first year because I forced vacancy, did rehab, and I re-tenanted. We were always about 25% over market in our rents, and we were always full with a wait list. So that's a lot of work, right? So you have to determine, do I have the time to get that kind of education? Is that education available? It's just not really available anymore. Phil has great um, commercial real estate teaching, and it's online at the cannabis incubator website. You can drill into that, and you can look at that high level teaching and become a sophisticated investor. But it is a lot of work. So let's look at passive investing. What does that look like? Well, maybe you don't have a few years to put into your commercial real estate career yet, and you want to make money while you're running with the experts. You want to see what they're doing, learn what they're doing, and do it correctly the first time, and be able to um, learn along the way. So the experts are bringing, like we're bringing 400 years of commercial real estate and construction experience to our deal. We don't have 10 co-GPs with 3 years of experience. It just doesn't have that depth. And that's what's messed up the market is a lack of experience, a skill set gap. So we want to learn with people who have that knowledge. We want to bet on the jockey, the team, and we want to bet on the deal, the horse. We're going to bet on the jockey and the team. Does that make sense to everybody? Make sense? Okay, so that is the advantage of passive investing is we are learning along the way and we're making money along the way. Advantages of passive investing in commercial real estate. I don't have my phone on me, so somebody's going to have to let me know when we're at the top of the hour, please. And we'll give you a full hours of training, an hour of training. So advantages of passive investing into commercial multifamily. It's half as risky as having your funds in the stock market in your 201k. Who has a 201k, not a 401k? Show of hands, give me a thumbs up in the chat. If you have a 401k and it's become a 201k, that's a concern. We don't want to be that frog that gets put in a pan of cold water and the heat gets turned up and we just kind of get used to it. You know, losing money in the stock market is a big deal and we want to stop the bleeding. So we can take our IRA, our 401k, we can use Quest Trust. We use Quest as the custodian, and we can turn it into a self-directed instrument and you can invest in somebody else's property. You can't invest in your property that the IRS says you can't, but you can invest in somebody else's property. Now, I recommend Quest Trust. We have, I think, 12 contracts that have been approved by them and the wires have come, but it's an arm's length transaction for us with Quest Trust. It'll take about a week to have them set up your new account, and it'll take about a week for legal to review the ownership documents and wire the funds. It's very streamlined, and it's questtrust.com, I believe it is. Quest Trust IRA or questtrust.com. So really good. I know that they offer a referral fee. They've offered us a referral fee if we send people there, but we don't take it. We want it to remain an arm's length transaction. And their front end people are some of the best. We have some other investors who have come in with other custodians, but Quest is just the best. Commercial multifamily is less risky than single family because the owners are diversified by many tenants paying the mortgage. So look what I did in my first property, my 16-plex. I went way down on my occupancy rate. I forced 80% vacancy. That meant I have 20% of my tenants that I decided to keep. So I loaned my property money with my discretionary income, and then the property paid me back. And within a year, I doubled that property value, and it was worth it. But on a normal basis, on a low crime property, maybe a B property, I don't know. There's a lot of drugs around. You don't have to force that much vacancy. I just had to force a lot of problems out, and it was well worth it. So if the bank knows that the tenants are doing what? All of those multiple tenants are paying that mortgage down. Now, the bank is going to require that a deal have a 1.2 or a 1.3% debt coverage ratio. Who knows what a debt coverage ratio is? Debt coverage ratio, sometimes called debt service coverage ratio. Okay, so this is a great question to look at, right? So a debt coverage ratio is what the bank requires. And that says that for every dollar you pay out, you have to have $1.20 or $1.30 coming in to pay your debt. That's a debt coverage ratio, 1.2 to 1.3. So let's look at our deal. On our deal, our debt service ratio is about 1.8. For every dollar that we are sending out, the stabilized year one budget says $1.80 is coming in. We're well under, and that gives us a buffer. So when the market changes, we have that buffer. Now, some of us are in the situation where we may have to do a 1031 exchange because we sold a property, or we need to have um, depreciation expense uh, to post against our high income. If we're a high wage income earner, then we want to have some depreciation expense to post against that. And what will happen is that um, multifamily depreciates at a rate of 27 and a half years because you have people in there slamming doors, walking up and down the stairs, using their HVAC system. So the roof is going to deteriorate over 27 and a half years. The HVAC electrical systems will depreciate. The parking lot will depreciate. So what we're doing is we're doing a cost segregation study. Has anybody ever heard about a cost segregation study? Okay, perfect, John, yes. So that is a CPA-like person who will run a report, a depreciation expense report, and they're going to take that 27 and a half years of depreciation and force it down into the first year or two. And we can distribute it amongst our partners. So you can take some of that bonus depreciation and apply it depending on your tax situation against your W-2 wages. So ask your CPA about how bonus depreciation can help you pay less in taxes. Okay, so what question should I be asking about the deal? Uh, who are these people in the company and who are the partners in the company? What is their track record? So let's look at our example as a case study. So we have our 23 acres that we're developing right now. We're going to break ground in a couple short months, and that's the Prestige at Mayhill. But we also have our sister property that sold in 2021, also the same asset class of Class A luxury. It was built on 14 acres, built in 2018, and sold for a profit of 22 million in 2021. It also has the same tenant type, the 30-something building their career and not sitting around thinking, how am I not going to pay rent this year? But they're building their career and paying rent just as an afterthought. And I only saw rent concessions or rent specials on 22 North in Austin one time during the pandemic. So that's what we're doing again with the Prestige at Mayhill. Do you have access to the property? Are you able to uh, drive around or see some YouTube videos of the surrounding neighborhood? Or do you not have permission to get on the property and check out the investment? Now, what I've done in the past, over the past 20 years, is I've gone and I've looked at everything and taken pictures, etc. And if anybody asks me what I'm doing, I'll just say insurance. And that always works. But remember, this is your responsibility to be doing this due diligence, to be going to the DCAD for the Denton CAD and checking out that parcel number and seeing who is on the ownership documents on that parcel of land. Is the property the way that it was described? It doesn't have to be anything more than the way that it was described. What gaps could the sponsor be missing in their evaluation that you see? Oh, there's cracks in the side of the building. Foundation problems? That can be expensive. So we want to be doing that due diligence ourselves, that physical due diligence ourselves. This is a great one, number 5, because boy howdy, that underwriting is so important. We want to be using worst case scenario and medium case scenario underwriting. Ultra conservative bank underwriting is what we use. And for the longest time, before we had our cost bid out, we used worst case scenario underwriting to disclose the performance and the pro forma that we saw on this property. And the way everybody slept well at night. For the most part, you're going to be seeing syndicators rather than operators. The syndicators are going to be giving you the blue sky pro forma. What happens if everything goes right? That never happens. We always buy commercial based on 2 things, and we've talked about this before. Who knows what those 2 things are? We always must have these 2 things when we're buying commercial multifamily, commercial anything. One is cash flow and the ability to increase cash flow. One is appreciation and the ability to see that property appreciate in value. We always must have this, and that's why we may be easily analyzing 50 deals or 100 deals. We've got to have that. Why is that? Well, let's look at what went wrong in the market over the past couple of years and why these projects are in trouble now. They can't get a refi without a capital call. That's bad. So the market doubled in price and people kept buying because the gurus were saying, hey, buy, buy, buy. It doesn't matter, just buy doors. And so it had no room to appreciate. And what happens is it will depreciate. There's no room to appreciate anymore. You're not going to have that buffer there, and you're not going to have that upkick when you sell. You're going to lose money. So they were depending on cash flow. They could see a little bit, they could put millions of dollars into the CapEx, the capital expenditures, but now they're struggling with the cash flow in the Class C properties, especially. Class A and B are better, especially in Dallas. Different market, different subject, but you see a lot of rent compression right now, and now they're not getting the appreciation, it's already gone, and they're not getting their cash flow. So that's why they can't refi. They're stuck in the middle of a bad deal. And my opinion, all during that season, that couple years when everybody was buying wrong, is I can't believe they're doing deals like this. And now this is a very honest market, and I don't want to be laughing if people have lost money, but I'm just saying those syndicators did not know what they're doing like an owner of a property does. We're owners, we're not syndicators. So be careful. People need to know what they're doing, and it's not the 10 co-GPs with 3 years of experience. So what happens on a good deal, on a stellar deal, on a smoking deal? We have room to increase rents, and we have room to let the property value appreciate. We want both. But in case the market happens and something happens, we want to have at least one. We want to have at least an increase of cash flow so we can make money. Or if our rents are staying flat then we want that property value to be increasing so that we make money on the sale. So that's a safe deal. And I want to hit this point hard that a safe deal is where you can be, you have room to increase rents and you have room to increase appreciation. And we want both, but we're safe if we have either. That's a safe deal. That's a really key component to commercial multifamily because you have got the diversification of units that protect you because you have 100 people paying the rent, not one. In single family, you're 100% full or 100% vacant. Just like in a standalone commercial property, like a Care Now standalone, you're 100% full or 100% vacant. And that's risky. Here's some mistakes that passive investor owners make. Not understanding the deal structure. Well, what's the deal structure? What kind of deals structures have we seen? Like an 80-10 split where equity partners get 80% and the sponsorship team gets 20. That's kind of normal. I've seen deals where the ownership team gets 30 and the equity partners, the LPs or limited partners get 70. So if we look at our deal, the Prestige at Mayhill, we're doing a 90-10 split where the developers get 10%. That's a standard developer fee. And the equity participants get 90%. That's one way that a deal can be structured. Another way that a deal can be structured, which is important, and we've mitigated this risk, is we're offering a high return, probably double what you're seeing in other deals. We're also offering collateral as part of the deal structure. So on other syndications, you're going to have the property in one LLC, and then on the side, you're going to have the investors in an LLC or a limited partnership. That's the way the syndication attorneys want it set up. Well, we didn't do it that way. We collateralized and securitized our investors. So we delivered the Prestige lot into an LLC in June of 2023, and we put our investor partners right in that same LLC. So you're collateralized. God forbid I go to heaven early. You're still collateralized. And I am all for transparent working relationships, all for great communication, all of that good fluffy stuff. But I am heavier on collateral. And so as a fiduciary, I want to make sure that our partners are collateralized. So we have an abundance of equity in our property because of the value and because of the work of the entitlements. We doubled the property value again in the first year here. And we have collateralized our investors with the property itself. And you're never going to find a better deal than that. So I would say, look at this case study as a stellar example of how to protect yourself and bump it up against whatever anybody else is telling you. So that's the protected way to invest. We're talking about a passive investment. We still have the due diligence, but we can rely more on the experience of the owner. Okay, so we talked a little bit about the tax benefits of passive investors. Depending on your tax situation, you've got that bonus depreciation that can be applied against your W-2 income in some cases. You've got tax benefits for investing before the end of the year. And a lot of people have been talking to their investment advisors or tax attorneys or CPAs, and they're being told that they need to do something to reduce their tax liability. You can also invest in with your IRA or 401k, and you can defer that tax. So if you have a 401k and you didn't pay tax going in, you still owe that tax. Sorry, but it's not tax exempt, it's tax deferred. So I see some good questions going to the chat. We're going to stay on for Q&A and take care of that. It's tax deferred. So if you are deferring your tax liability with your 401k or IRA, then you can continue that by investing in somebody else's property by setting that up as a self-directed IRA through Quest. If you have a 1031 and you sold a property, you have 45 days only to identify that next property. Trying to time the market, and David talks about this too, doesn't he? He's like, you can't time the market. Phil talks about this. You can't time the market. Deals are high, expensive, but you can find an off-market deal. Like we found the Prestige, we found it on an off-market deal. Excuse me. And it had $3 million of equity already in the land. That's an advantage. We didn't have the pressure in this seller's market to have to go against a bunch of bidders either. So even though prices were really high in the seller's market and people had kept bidding those prices up high, we found a deal because it was off market, and I was searching the internet and driving the miles, and I saw a sign that had a seller's cell phone and information on it. Called him up. So you can't time the market. You have to be out there looking for good deals all the time and analyzing 50 deals to find that one, analyzing 100 deals to find that one. And pretty soon you'll get used to the numbers and you'll go, okay, that doesn't feel right. Pass, pass, pass. Oh, maybe I'll do a little bit of due diligence on this one. And you can start getting the feel of that due diligence by looking at it that way and analyzing a lot of deals. Now, here's one point that I think is really crucial, and maybe newer investors don't understand this, but who are the deal killers of the world? Deal killers. A CPA, if they don't have real estate in their background, can be a deal killer because their job is to protect you. Now, if they're a real estate CPA, they understand that. They understand the tax advantages. They understand the passive income and all that good stuff. Who else is a deal killer? An attorney? Any attorneys in the room? I have to preface this with this statement. I am not an attorney. And we want them to be looking at our deal, but they can't be the all in all, right? If they don't have real estate in their background, they're going to protect you, and they're going to just say, no, don't do the deal. So we want to be careful of that. We want to understand what their role is. We talked a lot about the debt coverage ratio, debt service cover ratio, where $1.30 needs to be coming in for every dollar going out. That's what the bank requires. And then looking at the financials, looking at the audited financials, the stabilized year one budget, the 7-year pro forma. I don't want to go too fast on these because I know this is this nomenclature and some people don't. So stabilized year one budget. The pro forma for 7 years. the occupancy break-even point. So at what occupancy rate are we going to break even on our financials? We want to look at the rent roll. What are they charging? What are the size of the units? We want to be understanding that and kind of get an idea. On a Class A luxury, we have oversized units. So our unit size is going to be about 1,200 feet. It's a big unit for a 2-bedroom. It's a nice big unit with vaulted ceilings and like that. So we want to understand that as well. So people can come in with cash. Now, a lot of the big investors, that's how they invest, guys. They just do. They invest with cash because they don't want to mess around with 401k, IRA. I haven't had a 401k in 20 years. You know, we're all into the property and our funds are sheltered in that hard asset that we can drive by. It doesn't go away based on a whim of the stock market, but it's going to be there and we can drive by it and check it out. Most of the big investors invest with cash, but you can come in if you got a 401k losing money in the stock market. You know, that's a bleeding situation. You want to stop that bleeding and you want to put that to work. Maybe you have an IRA that's not making any money, you know, or making a little bit of money. It may be sheltered, but it's not making money. And we want to be sheltering that capital and multiplying that capital. So we'll turn it into a self-directed vehicle and you can invest in somebody else's property. That's the IRS regulation. 1031 exchange, where you can get that tax benefit of deferring capital gains tax. You sell a property, you have 45 days only to identify that property, and you can invest with 1031 money here. The typical value add, we've talked kind of about this, right? We've talked about an existing apartment, and we're going to go in and we're going to force value. But in the development, we're forcing value on the land. And that's why we have an increase in profit. We have more profit to share. So this is actually a picture. It's a beautiful picture of 22 North in Leander, Texas. Class A luxury, tuck under garages, beautiful common area, 30-something tenant type. They're building their career and paying rent, you know, just as an afterthought. Open common area. We were just in 22 North in Austin, Christy and Tally and I and Zoe, and we did a walkthrough and some videos of that property. So if we're going to look at the financials, that would be the stabilized year one budget. What does that look like if you reduce some expenses that can be reduced and normalize some expenses that can be maintained a little bit better? Get 6 bids on a new gardener, landscape person. See if there are any leaks. Try to reduce your taxes by protesting your taxes. That's what we do as owners, not as a passive investor. You don't have to do all that work, but it's good to understand what's going on with your asset. 7-year pro forma. What's it going to look like in a year or 3 years if it continues at this rate? So if you'd like to do a little due diligence, you can log into our Investor Club portal and you can see all the documents that are there. Feasibility reports, appraisals, approvals by the city, civil engineering reports, traffic impact reports, water, wastewater impact reports, profit generators. How is that money going to multiply itself? The last part of being a passive investor is to go into the investor club portal, sign your subscription agreement and the private placement memorandum. You know, the SEC has two roles. One, they want to protect you. So they're giving you that private placement memorandum, the PPM, with all of that legally is to protect you. They really do want to tell you everything bad that could ever go wrong in any real estate transaction. No, living in a house is risky. Houses can burn down. You should never live in a house. Well, you know what? I'm going to live in a house. The second rule that the SEC is they want to provide good deals. They actually do want you to have something to invest in. And so they are supportive of good owners and they want you to have good vehicles to invest in. This is a picture of 22 North, the common area. Beautiful, 30-something colors. Go look at the deep dive review. We have a 30-minute deep dive where we talk about the market, we talk about past performance, and you can join the Prestige Investor Owner family. Talked about the SEC goals, right? Protect, offer good deals, and protect the investor. Yep. So I think we're wrapping up here and then we'll get to these chat questions, okay? So what is an accredited investor status? Because we're in a 506C Reg B offering right now, we will be checking accredited investor status. If I'm an individual who has made 200,000 or more in the past 2 years, and I expect reasonably that I'm going to make $200,000 next year, then I'm an accredited investor. Or if I'm a couple and we make $300,000 together for the past 2 years with the reasonable expectation of reaching the same next year, I'm an accredited investor. Or if my individual net worth exceeds $1 million, but that's not including my house, my primary residence, no. The SEC is offering more ways that people can be an accredited investor by having a license under the SEC, a law license, Series 7, Series 65, or Series 82 securities license. Or I own a business that has $5 million in assets and that's not including my house. So at that point, in a passive investment, you would sign, initial the private placement memorandum and wire the funds. Now we give monthly distributions and quarterly reports. That's what we do. Okay. So if you're an accredited investor and you want to take a picture and get more information, that's all we're doing is getting more information as an accredited investor. Just take a picture of that QR code and it'll take you right to a landing page where you'll be able to find out more about what we're doing with our property, what the accredited investors are getting. The deep dive is also attached to this link. We're not running a 506B right now for sophisticated investors, but in a couple of years we will. We already ran a 506B for friends and family. We raised $4.5 million. So, your money is not the first in. So a 506C is accredited investors only. We went through that list and we give people time to get that QR code and find that link. So if you are looking at a deal, then you want to be able to have the same kind of information. This is a really good case study of a stellar investment. I'm not just saying that. I really want you to know what a good investment is. We have about 20 lenders wanting to lend us construction money right now at too high. And we're telling the banks no. Other properties can't even get a refi done without a capital call. That's bad. And we're telling the banks no, and we're going with equity, we're going with cash. So this is the kind of deal that the banks love because it's conservatively underwritten. And I want you to kind of get that feeling of what a good investment is. Okay, let's get to that chat, guys. What do you say? No extra charge. Oh, somebody gave me a 5-minute warning in the chat, and I was not paying attention to the chat. Okay. Thank you. Does depreciation also apply to new construction? Yes, it does. And thank you for that question. So, Maggie, the way that that works is we're building 10 buildings and we're getting a certificate of occupancy from the city on each building that we get. So on our development, um, we don't have to wait to lease up all 10 buildings before before doing a cost segregation study. No, we can get a couple buildings in pre-lease and run the cost segregation study and do that depreciation expense on each building. Because once it is built, the roof starts declining. The parking lot starts being driven on and it starts depreciating. It's getting sun on it. The HVAC systems are now operational. So we have our certificate of occupancy. We can run that cost segregation study. And for that depreciation from 27 and a half years down to the first year or two and share that with our partners. So that's how we share depreciation expense on a new build. It is after the building has a CO, certificate of occupancy, and we run that cost segregation study by an expert. Okay, please explain the further meaning of collateralizing in this context. Yes, thank you, Marilyn. So what happens is we want to make an investment in somebody's deal. And on a syndication with a syndicator, they will have the property in one LLC to protect that property. And then their syndication attorney is going to recommend that the investors be on a side LLC outside of the property or a limited partnership. It's two different entities. So you're collateralized, but the reason that the SEC attorney is, or the securities attorney is doing that is to protect the owners from the investors. I had a 20-minute conversation with our securities attorney and finally he got it. I said, I want to have my investors inside the property LLC. So in June of 2023, we delivered our 23 acres into our LLC. And then we also signed the agreement with our investors to put the investors inside of the property LLC itself. So, again, I'm all for transparent working relationships, all that fluffy stuff, but I want to make sure as a fiduciary that we're collateralized, that our investors are collateralized. So God forbid I go to heaven early. Everybody is paid off and made whole and they get their profit that they were promised because the property is the collateral. The property is the security. In fact, the SEC says that if you are doing a syndication or a raise, then you are offering a security. That's a separate way to use that word security, but also we're securitizing the investor with that hard asset that doesn't walk away. And we're putting the investors right into the property LLC. So there's no arm's length there. There's no detachment from the equity that's in there. Okay, will investing with a self-directed IRA also benefit from depreciation? Does it make a difference whether it's traditional or Roth? So these are great advanced questions, right? Renala, they are, if you have a self-directed IRA, you will receive bonus depreciation from us. You need to ask your CPA how you can apply that to your tax situation because everybody has an individual tax situation, and that's a question for your CPA. Now, Quest, in an arm's length transaction from us, will help you with your Roth. A traditional versus a Roth IRA, both can be used with Quest to become a self-directed IRA, and they'll help you. So they'll help you with that translation of that Roth or traditional IRA. 1 week it'll take. And then the second week, they'll review your ownership documents and wire the money. So that's a great question for Quest Trust. And they have about 12 of our contracts. We use somebody else came in with a different custodian, but they didn't have the level of knowledge to really help the clients. Okay. All right. Thank you. Thank you. Thank you. So if there are no other questions, I'm going to go ahead and stop the recording, and thank you for your time and attendance. And we are available on the Big Dog Facebook as well if you have further questions. Thank you.